This week, President Trump has proposed penalty-free 401k withdrawals to fund a down payment on a home. Should older Americans raid their 401k nest egg or consider a HECM for purchase? That's the question we'll address right after this short message from our sponsor.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back, and thank you for joining us. For years, policymakers and housing advocates have searched for ways to make home ownership more accessible. With home values remaining stubbornly high in most markets across the country, the housing affordability crisis continues. The typical monthly payment about doubled for an ordinary family buying an ordinary home, and the down payment they needed to buy a home went from about $15,000 to about $32,000. And so there's a lot of room to make up, said National Economic Council Director Kevin Hassett in a recent interview with Fox News. Against this backdrop, a new proposal has entered the conversation, allowing Americans to tap into their 401k retirement accounts penalty-free to fund a down payment on a home. Presently, there are no specifics regarding the size of this 401k homebuyer exemption. Now, on the surface, this sounds appealing. Retirement accounts are often one of the largest pools of capital that most households will have. And while such a proposal may help a younger would-be home buyer who has a 401k to get into a home, there are clear trade-offs, especially when it's compared to an option that has been available since 2009, the HECM for purchase. So today, let's compare these two strategies side by side, and we'll begin with a 401k withdrawal strategy. Under current law, pulling money from a 401k before the age of 59 and a half typically triggers a 10% early withdrawal penalty, plus ordinary income taxes. The proposal being discussed would remove that penalty for the funds that are used toward a home purchase, but importantly, it would not eliminate the tax bill, and that distinction matters. Even without the penalty, 401k withdrawals are still treated as taxable income. Depending on the amount withdrawn, that can push a homeowner into a higher tax bracket and reduce the eligibility for health insurance premium credits for those on the exchange, or create an unexpected tax bill the following April. But the highest cost isn't just taxes, it's the opportunity cost. When retirement funds are pulled early, they don't just disappear, they stop growing. A dollar removed from a 401k today is a dollar that doesn't compound for the next 10, 15, or 20 years. And over time, that can translate into thousands or hundreds of thousands of dollars in lost retirement assets. Economist Peter Schiff, who warned the public of the impending housing crisis years before the 2008 Great Financial Crisis, well, he's not a fan of the proposal. In his latest attempt to keep overpriced home prices from falling so that more people could afford them, Trump will soon unveil a plan to allow home buyers to use their 401ks to fund down payments. That way, Americans can deplete their retirement savings to overpay for a house. Another concern for retirees is that funding a down payment with a 401k typically will require a traditional mortgage for the balance of that home purchase. And for older homeowners, that means an ongoing principal and interest payment for the next 15 to 30 years, in addition to property taxes, insurance, and maintenance. So retirees may want to think twice before getting a mortgage that won't be paid off until age 90 or 100. While the proposed policy may lower the barrier to get a home, it also does so by shifting that risk forward. In essence, home buyers who tap into a 401k to purchase a home are trading their future retirement security to buy a home today. So now let's contrast Trump's 401k proposal with a HECM for purchase, which applies specifically to those home buyers age 62 and older. With a HECM for purchase, a borrower typically uses the proceeds from the sale of a previous home and often is paying 35 to 40% of the purchase price depending on their age, and then they finance the remaining balance with a reverse mortgage. But here's the key difference. there are no required monthly mortgage payments. So as long as that borrower does remain in the home as their primary residence and they do keep up with their property taxes and insurance and maintenance, that loan is not going to require any monthly payments. So the interest is going to accrue over time, and it's going to be paid when the house is sold or the homeowner permanently moves or passes away. But from a cash flow perspective, this is a fundamentally different structure. Instead of tapping a retirement account to reduce a monthly payment or to qualify for a home purchase, the HECM for purchase instead eliminates payments while preserving retirement assets for future income and cash flow, healthcare emergencies, or lifestyle needs. And unlike a 401k withdrawal, reverse mortgage proceeds are not taxable income. Now, that's not going to happen with a HECM for purchase, but it still needs to be pointed out. And that distinction can have a significant impact. Of course, the HECM for purchase is not without its own trade-offs because you have interest accruing over time and that loan balance will grow. That means the heirs may inherit less equity than they would under a traditional mortgage, although they're never responsible for more than the home's value. Now, to summarize, the key differences are that a 401k withdrawal, it sacrifices future financial security to solve a current housing challenge, while a HECM for purchase for older home buyers sacrifices a portion of the future home equity to preserve current and future cash flow. And those are real different trade-offs. So let's look at a simple example. A 62-year-old buyer wants to purchase a $400,000 home. Under a 401k strategy, let's say they withdraw $100,000 for a down payment. Even without penalties, they're still going to owe income tax on that withdrawal, and they also are going to likely need a mortgage on the remaining balance, and that means payments for the next 15 to 30 years. With a HECM for purchase, they might use $160,000 from the prior home sale and then finance the remaining $240,000 with a reverse mortgage, but there are no required monthly principal and interest payments. Same house, very different financial outcomes. So what's the takeaway? For younger buyers, a penalty-free 401k option, it may feel necessary or a compromise, but it's one that should be approached with caution and a clear head. For older Americans, especially those that are entering or already in retirement, a HECM for purchase, it often represents a more strategic reallocation of assets while preserving retirement accounts for future growth and stabilizing cash flow, while at the same time reducing exposure to payment risk. In short, these strategies are not interchangeable. One trades retirement growth for home ownership. The other trades some of the future equity in the home for financial flexibility. And that is really the direction where good planning can begin. What are your thoughts? You can leave those in the comment section below. And if you would share this video on your LinkedIn network if you found value in today's episode, we really appreciate that. Don't forget, we have a YouTube channel. Be sure to subscribe. That way you never miss any of our latest content. If you'd like to catch up on the latest reverse mortgage news and trends, you can do that in our weekly podcast, HECM World Weekly. We have both an audio and a video edition. Listeners can listen and subscribe on Apple Music and Spotify. Thanks again for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find right here at HECM World. Have a great week.